ANZ research forecasts that there will be a rate cut in February, but that it'll only be one of two. So we are seeing some really encouraging things on the path of inflation right now. Electricity is going very quickly to bed, everything else is going less than expected. That should be enough to push the Reserve Bank over to the edge and give us that first cut.
Paul Bloxham, do you share Adelaide's outlook?
Well, we share the view that we think there's only going to be 2 rate cuts this year, but we don't think they're going to get over the line by February. We think that when they get to the February meeting, they'll still have core inflation that's above their target and still falling quite slowly. And we already know this, the labour market is very close to full employment, if not a bit beyond at the moment. So a fully employed economy where inflation's falling slowly, and we don't think they're going to be able to convince themselves to be able to deliver the first cut in February.
Adelaide, to what degree does a cut depend on the December quarterly CPI figure out this Wednesday?
The quarterly CPI figure is critical. If there is that upward surprise, that's going to put a lot of doubt on a February rate cut. Whereas for us, the labour market is probably a little bit less important. We think just given that price pressures seem to be coming down across business surveys and business liaison programs, it looks like wage growth is set to slow. That above full employment metric may become less important. But for us, it's the inflation that's critical. And for the Reserve Bank, that's their main mandate. Their inflation has to be within the band. So if inflation is too high in Q4, that'll take that rate cut off the table.
Just quickly, Adelaide, what is your forecast for the quarterly figure?
0.5% for trimmed mean. So if you annualise that out, that's actually pushing inflation at the bottom of the band. Of course, we don't really like to annualise it and take that number too seriously because inflation is seasonal, which means things like Q1 when school fees come out, things like that, that tends to skew the numbers a bit. But 0.5 is our call, and that's a really nice low number, especially considering that those non-tradables inflation, things like services, have been running quite high lately.
Paul, what do you expect to see?
Well, we certainly think that trim mean number could be on the lower side. We've got a 0.6 in as our central case for that Q-on-Q figure. But one thing you've got to keep in mind is it's quite likely that the government subsidies, the electricity subsidies and the rental subsidies, are going to have some impact as well on that trim mean figure, so that they're likely to have put a bit of downward pressure on that figure. And we think the RBA is going to be very, very much of the view that they need to look through that effect. They're looking to see the pulse of inflation. And for us, the labour market means a bit more, because it's not just that the labour market's at full employment, but because it's so tight, it's telling us that it's difficult to believe inflation's going to continue to come down fast enough to believe it's going to get sustainably to 2.5 to see the RBA cutting in February, in our view.
OK, so a couple of questions on that. Paul, does the Reserve Bank need to wait until core inflation, or that trimmed mean, is within the target band?
No, I don't think it does, but it needs to. The board needs to convince themselves that inflation is going to sustainably get back to 2.5%. And if we get the 0.6 we're thinking will come out in the trim mean on Wednesday, that would mean it would be still at 3.3 on that trim mean measure. They need to convince themselves it's going to fall from 3.3 all the way back to 2.5, and not 2.5 just temporarily or in the short term, but in a sustainable sense. And we think because the labour market is so tight, it's not necessarily the case they're going to be able to convince themselves that inflation will fall sustainably back to that target. And that's why we think they're more likely to stay on hold in February.
Adelaide, in 2024, the RBA governor talked a lot about unemployment being at historically low levels. Does the RBA have to be convinced that the jobless number is going to go up before having confidence about cutting rates?
The Reserve Bank currently thinks that the kind of magic unemployment number, the non-accelerating inflation rate of unemployment, is around 4.5%, which is higher than the current unemployment rate of 4%. But I think that if they see things like wage growth stalling or at a more acceptable level, if they see inflation momentum coming down, they may not need that 4.5% magic number in order to reduce rates. I think what's also really important is one rate cut is not going to pull us back to a neutral territory. We'll still actually have an interest rate that's high enough to keep the economy moving more slowly than usual. It's just going to be taking the kind of intensity of that restrictiveness off in Feb. But look, I think as we see the price changes through the economy this year, that 4.5% is going to become less important for the RBA in our view. ANZ research actually expects that NAIRU, the non-accelerating inflation rate of unemployment, is actually actually closer to 3.75 to 4%. We don't think the labour market right now is so tight that it's a big problem, especially considering that much of the increase in employment lately has actually come from outside the labour force into certain healthcare roles, rather than coming from real tightness and a reduction in the number of unemployed people.
Adelaide, after February, when do you expect the next rate cut?
The ANZ research forecast for the second rate cut from the Reserve Bank is August this year, and that, in our view, will be the last of the rate cuts. The labour market is still resilient. We're seeing household spending, the malaise is limited, and all of those factors together will limit the Reserve Bank from being able to push the cash rate down any further.
Now, Paul, unintentionally, I cut you off. What were you saying?
I was going to say, that view is very, very different to the RBA's own view. As Adelaide said, the RBA's told us that they think that the full employment rate, the NAIRU, is around 4.5%. But since they told us that back in late November, they've also published some of their internal research showing that actually their most recent view internally has been to revise up, not revise down, their own estimate of where the natural rate of unemployment is. And we're not talking about small numbers here. We're talking about the unemployment rate at the moment being at 4%, which is a long way below 4.5% in the scheme of things. So I think the RBA is going to still take the view that we are still at or well beyond full employment at the moment, and that's going to be something they really need to factor into their view in terms of the outlook for inflation. On wages growth has passed its peak. It is starting to slow, but the thing is, you can't look at that wage number without properly thinking about productivity. Productivity is a lot weaker than it's been in previous times, and so weaker productivity means you need wages growth to slow down even more if it's going to put downward pressure on inflation. So we're still of the view that the labour market is going to play a big role, and the labour market is still too tight to think that you're going to sustainably get inflation back to target, or at least that's what we think the RBA is going to judge.
Paul, what is the earliest time frame you believe we'll see a cut here in Australia?
So we've got a cut factored in for the second quarter. We think the RBA is going to probably want to see another inflation print before they're prepared to cut interest rates. But I think one of the things we've also been highlighting, and we've probably been the one most vocal on the street, is that it's possible that the RBA might not get to cut interest rates. I mean, we're talking here about the RBA cutting interest rates because inflation comes back to their target sustainably, but we're in a fully employed economy where inflation's falling very, very slowly. It's quite possible, there's a risk out there at least, that we're talking about these rate cuts, but maybe it'll take them longer, or maybe they just won't get there at all, because inflation is falling slowly, the labour market's tightening up, growth is picking up, and then if we look offshore, we look at the rest of the world, well, I think there's some risks out there to the upside on inflation that we need to factor in as well. So we've been assigning some risk at least to the idea that it might take even longer, or that we should sort of think that maybe rate cuts are not really necessarily going to be delivered.
Adelaide, Timbrell, Paul Bloxham, terrific to have you both on the first program for the year. Thank you.
Thank you.
Thank you.